Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is finance and real estate investment expert Ehud Gersten. Now, Ehud is a managing partner at Perch Welch, an investment advisory firm that specializes in alternative investments, 1031 exchanges, and Delaware Statutory Trust. Now, while he no longer practices law, he is still a licensed California attorney. He is also a licensed California real estate broker. And for more than a decade, Ehud owned and operated a highly successful law firm in San Diego, focusing on real estate and consumer rights. Now, Ehud also holds a Bachelor of Arts degree in political science, as well as a law degree from the University of Auckland in New Zealand. And he additionally holds a Series 37, 66, and 63 registrations. And so, guys, without further ado, I'd like to welcome Ehud to the show. My friend, how you doing today?
I'm doing well, Kevin. Thank you for having me.
I'm excited to have you. Excited to talk about the world of DSTs, and but what I'd like to do before we dive into the meat of the show, I just ran through that brief introduction. I know there's a little bit more to the story in the background of yourself, so maybe Eda, if you would take a few moments, just fill in some of the blanks for us. For those that aren't familiar with you, don't know anything about the firm, who are you, where you came from, and what is it that you do?
Sure, absolutely. And again, thank you for the opportunity. So my background, without getting too deep into the weeds, like you said, I went to law school, did a law degree in New Zealand, ended up doing another law degree in Boston. Didn't like the cold weather in Boston. Ended up in San Diego and started working as an attorney here. And I did real estate work for quite some time, litigation, transactional. And I was ready to sort of pivot out of law. And right about that time, a friend of mine named David, actually, that owned a building where I was renting an office space from him. He's also an attorney. And he came to me and said, I'm thinking of selling the building and I'm retiring and I want to do a 1031 exchange. Can you help me with it? And I didn't really understand what he meant by that. We were good friends. And I said, what do you mean help? He says, well, can you help me find an alternative, because I'm doing the 1031. And I had heard of, I knew about 1031s. I was in the world of real estate and I thought I knew everything there was to know about 1031s. And it turns out I didn't. So fast forward, I started doing research looking for different opportunities and options for him in the 1031 world. And I came across DSTs, or Delaware Statutory Trusts, and just was blown away. I mean, I couldn't understand how I'd never heard of this. I had friends in the law world and real estate that had never heard of this. So started doing a deep dive, and I was already looking to leave law. And went out, got my securities licenses, and said, this is what I want to focus on. And did that, started working, met Ben, my business partner, who at the time was working at one of the DST sponsors. These are the companies that put these deals together.
Mhm.
And, we remained friends, and I was doing my thing, he was doing his thing. And then one day, he reached out to me and told me, I'm thinking about going out on my own and starting something on the advisory side, so to speak, on the counseling side of the DSTs. Do you want to join me and we can do it together? And I said, sure. So we did. We started Perch approximately about 4 years ago now. And, we quickly have grown to, I think, I'm obviously biased, but I think we've grown to one of the preeminent DST service providers, essentially, in terms of brokerage. And we can get into what we do and what we believe that needs to be done to help clients. But that's sort of the view from 30,000 feet in 3 minutes or less.
No, I appreciate that, and I want to get the basics quickly out of the way here, and I'm just going to make the assumption that the majority of folks that are tuning in today know what a 1031 is. If you don't, Google it or ChatGPT nowadays, right? That'll probably give you the baseline understanding if you're not familiar with it. But what I'd love to learn is for those that are new to to the DST concept, maybe let's talk about the basics of that, right? Because it sounds like even though you were practicing real estate law, you weren't overly familiar, maybe not at all, with Delaware Statutory Trust and how they kind of play in 1031s and in that whole world, right? And so let's if you would maybe explain what a Delaware Statutory Trust is, and I think more importantly how it kind of fits into a 1031 strategy.
Sure. Um, so the Delaware Statutory Trust, I mean, it's the reason it's called a Delaware Statutory Trust is that it's because it's a trust that's created under Delaware law. Even though to this day I've never seen an actual DST property in Delaware, all of them are created under Delaware law. And there's also Nevada Statutory Trust, but the DST became the most popular one to create this wrapper of owning real estate. And DSTs, their purpose really was to hold property, to hold assets in a business trust. That's essentially what the purpose of it is. Throughout the years, DSTs have become basically synonymous with what we're going to be talking about today. But it's not only you could use it for other things to hold property in a business trust. And, in the late 90s, you had all these different sponsors, syndicators that were doing mostly PICs. And a few of them, especially in the early 2000s, they started doing DSTs. Problem that they had was that they didn't know whether it would pass legal muster, right? They were telling people, go into our offering and you can do a 1031 into our offering. But it wasn't clear, it wasn't legally clear whether the IRS would accept it, right? And that's a big ask of people before they invest. You're saying, hey, do this 1031 into my DST, and there's no clarity with the IRS whether it's acceptable or not. So in 2004, the IRS came out with a revenue ruling. It's Revenue Ruling 2004-86. And in that revenue ruling, it laid out the groundwork and the framework for DSTs and certain requirements for DSTs to comply with 1031 exchange law. And since that time, since 2004, I mean, we've just seen, literally it's multi-billions of dollars every year that people are doing into DSTs. But like my experience, not knowing about DSTs, and one of the reasons that, we do these podcasts, and the reason we talk to a lot of folks is that you find that a lot of professionals, CPAs, attorneys, real estate brokers that are in the space, they don't know about DSTs, a lot of them, or if they do, there's a lot of misconceptions. There's a lot of things that they think they believe that are true that are not. And look, it's not a perfect fit for every person. There's going to be people that it's better for. There's going to be people that it's not appropriate, which, we can talk about if you'd like. But basically, the DST wrapper works in such a way that, you have a DST sponsor. Let's say Cantor Fitzgerald, right? Big company out of New York. So Cantor may go out and buy, let's say, a $20 million multifamily in Dallas, Texas. And so they'll acquire that property. They'll actually buy the property. Sometimes they'll put financing on that property. Sometimes they don't. And then once they acquire the property, then DST investors, or I should say 1031 exchange investors, have the opportunity to invest in one of these offerings. And shall I pause there? I mean, I don't want to.
No, I guess I was going to ask a question. I don't. It's interesting. I know the basic framework, and we've done a number of ticks, and inside of fund, like kind of like sidecar letters and things of that nature. And so I'm familiar with that, but I guess I've never personally have been involved in a DST. I understand the basic framework, but how does a DST live and breathe differently than that of what your common tick structure looks like?
Yeah, absolutely. Well, that's actually a really good point. One of the reasons that DSTs became popular, especially in the mid 2000s and the mid 2010s, so to speak, is because in 2008, everyone remembers the Great Recession and the blow up of real estate, and a lot of tick deals just absolutely blew up. I mean, a lot of people lost a lot of money in ticks. And one of the reasons that ticks are different than DSTs is, first of all, with ticks, you essentially have to have, on major decisions, you have to have agreement between the people that have invested in the tick. Yeah. With the DST, you don't have that. With the DST, you have the sponsor, which is acting as essentially the asset manager, managing on behalf of investors. And that's why it's a trust structure, right? So they're acting essentially in a fiduciary duty to investors. You don't necessarily have that in a TIC structure. You can also have a lot more investors in a DST. You can have up to 499 investors. You don't typically have that many, but you can have a lot more investors in a DST than you would in a TIC. So the way that it's structured, now there's some restrictions, right? And a TIC, if it's got no debt on it, you can refinance the tenant. Typically, you can refinance. With a DST, you cannot refinance, right? So, I don't want to go too deep into one rabbit hole, but that's some of the big differences between TICs. And most of the syndications that we see today in the world of 1031s on our side, It's like 99% DSTs. You
Yeah.
occasionally have ticks. There are some sponsors out there, not many, that will do only ticks, but it's a different kind of legal structure, pros
Sure.
and cons. Yeah.
Yeah, no, that's great. So I guess maybe speaking to your typical profile of who might go this DST route, rather than just taking their 1031 and taking the relinquished property and buying an exchange, another active property. I mean, so what does the typical profile or the common profile look like of the person that is the ideal candidate for a DST?
The ideal candidate, I think it's anyone. The first thing I'll say is anyone that's tired of managing property, right?
Okay.
So a lot of our clients, first of all, you have to be an accredited investor to invest in DSTs. And I think one of the primary drivers of people investing in DSTs is they don't have to deal with tenants anymore. They're giving up the control, that's true, but they're also giving up the headaches that usually come with managing properties. And typically most of our clients will be north of 60, 65 years old. If you're 30 years old, and you're after it, then DSTs are probably too boring for you. You might want to go out and buy that Airbnb that's giving you 25% return. I'm exaggerating, obviously, right? Yeah, but yeah, that's the typical is landlords, people that have been landlords for many, many years, or even younger folks that inherited property and they don't want to manage maybe their parents or their grandparents' property. So that's one thing. So they're looking for passive income. They're looking for no management requirement or experience. They don't have to be experienced in management. They can hand it off to literally some of the biggest real estate companies in the country, these companies that are managing and putting these deals together. So I would say that's predominantly, and then that's one factor. And then the other one is diversification.
Mhm.
One of the biggest benefits of DSTs is the ability to diversify your real estate portfolio. And I'll give you an example. Right now, we're seeing the market like a roller coaster, right? I'm talking about the stock market. And so people are concerned. And if you put all your money, for example, in Tesla, right? Let's say your life savings was $1 million and you put all your money in Tesla, which would be a bad idea to put it all in one stock. I think they're down over 50% maybe at this point. I'm not quite
Yeah.
sure. So, and yet we do that as real estate investors. We do that all the time. We put all our money essentially in one main asset. That's where predominantly most of our wealth is located as investors. DSTs allow you to spread that risk, right? In the same way that you have a balanced stock portfolio where you've got diversification, because the minimum investment in a DST is only $100,000. You can take that $1 million that you just sold your Airbnb property or your condo or your warehouse or your industrial facility, whatever it may be, or your triple net, your McDonald's triple net, and you can take that $1 million as an example, and you can spread it out over multiple properties. So when we have situations where the economy is going like this, right, or it's like a roller coaster
Mhm.
ride, even if something happens to one of them, it's not going to completely destroy your entire portfolio, or at least it'll mitigate that risk.
Yeah, no, that's great. And I assume, at least from what I've seen, is that the majority of these DST investments are mostly like, core or core plus, you know, more stabilized type assets, institutional quality assets. Is that an accurate statement?
That's accurate, absolutely. So
Okay.
when you're looking at multifamily, it tends to be Class A multifamily. Occasionally, you'll get Class B. You're never going to see C or D in there.
Hmm.
These are all stabilized assets, cash flowing assets. It's extremely rare that they're not cash flowing from day one. So as soon as the investor invests, let's say they're doing a 1031 exchange, right? And they're in their 45 days. Let's say they're 20 days or 10 days into their 45 days. As soon as they close on the DST, which is a pretty quick process, I mean, we could do it in 5 days or less typically, 5 business days, they're already cash flowing because as soon as they close, that property is already cash flowing. They're earning that income. So it's basically investment real estate handed to you on a silver platter.
Got it. What's the typical cycle look like? I mean, the average person wants to go to 1031 route, they're going because they want to avoid capital gains, right? But most of the time, they're looking to kick the proverbial can down the road forever for estate planning purposes. So, how does one, assuming they buy into a DST, assuming it's a 10-year hold period, can you 1031 out of that DST 10 years down the road when the asset manager decides to sell the property and just keep rolling it, kicking that can forever?
Yeah, absolutely. We call it swap till you drop.
There you go.
So,
That's a better way to put it.
it's a better way to put it. Uh, and we have clients that love doing that. So it's typically the life cycle of a DST is anywhere between 5 and 7 years. So that's
Okay.
historically most of these assets will get sold within 5 to 7 years. So if you invest in a DST, you can expect to be in that anywhere from 5 to 7 years. With the projections, when the DST sponsors put these deals together, you'll typically see projections of 10 years. So it doesn't mean that it'll happen in 5 or 7 years. It could happen in less, it could happen in more, but typically 5 to 7 years. And you're absolutely right, Kevin. As soon as that property sells, as soon as that asset sells, the investor has the ability to do another 1031. They could take the money and invest it into a property that they buy direct. They can roll it over into another DST or DSTs if they like, or they can cash out, or they can do a combination. So they're right where they started when they first did the initial one. I can tell you anecdotally that the vast majority of the people that do DSTs end up doing DSTs again. Because you know that commercial, I think it's Staples, the easy button, right? You just click, it's the
Right.
easy button. It's you get quality institutional real estate that is being managed for you, and with the expectation of getting paid every month, it's not a bad deal.
Yeah. And I mean, and I believe like pretty much most any type of real estate investment, probably including DSTs. I mean, they're fairly illiquid, but I mean, are there structures that might have, some type of like cash redemption periods or options for investors, or is it kind of, hey, like we're in for the ride for the 5, 7, 10 year span?
You're in for the ride. And that's one of the things that folks have to be comfortable with, that once you get on that bus, until that bus stops, there's no stops along the way. Now, it's legally allowed. You can sell your interest. If you find a ready and willing buyer for your DST interest, you can sell it. That's not an issue. But there's no secondary market. I used the example before of a stock market. It's not like the stock market at all. Like you said, real estate in general is illiquid. DSTs are illiquid.
Yeah.
So people have to really be comfortable, and that's where we come in, right? And what we do is to do the research, to do the due diligence, and no deal is going to be perfect, but you try to pick the deals that are more than likely going to succeed based on fundamentals, so that when the investor goes into the deal, that deal is still going to be viable 5 or 6 or 7 years down the road when it sells.
In our standard syndication world, like I've been seeing over the years, there's some groups here and there that have been trying to create a secondary market, in the event that LPs, you want to find some liquidity or sell their shares. Is there any, I mean, I know it doesn't exist today, but have you seen anything like that? Any groups try to spin up some type of secondary market like that?
I've seen a few that have
Yeah.
tried.
Yeah. I
It's
was saying.
not it's not easy. And there's a lot of reasons why it's a challenge. Um, yeah, I've seen a lot try. I hope it happens one day, because I think one of the reasons that people are typically hesitant to go into DSTs is because they're giving up control, and then as a consequence of that, they say, "Well, I'm going to be in this DST for 5 years. What if I want to get out?" And while there's legally the option, they don't know if there's no market to buy, their official organized market to buy it. So I
Yeah.
think if that was to happen, and not just in DSTs, and syndications in general, I think that an improvement in the ability to sell your interest is going to increase. It'll improve, I think, the real estate industry.
Yeah. Well, let's talk about that. I mean, given that that might be a hesitation, just someone giving up control, right? They've come from a world where they've been managing their assets for, maybe potentially decades, and they're ready to slow down, retire, go spend some time on the beach, and so like this becomes a passive opportunity for them. However, like they still might have trepidation. I guess. Whereas their former life, they're running due diligence on individual properties they can get comfortable with, properties they're in control of. But like, what are some, I guess, guiding points you might have, or questions that potential DST investors need to be asking to determine both the operator and the opportunity that it's a good one, right? Like, what are the big red flags and good questions that they need to be asking?
That is an excellent question, because it's not just real estate investors that are asking that question, a lot of times we get their CPAs or their attorneys or whoever is representing them, like their other financial advisors, that don't understand what to look for. And it's a big issue. And one of the things that I recommend, I'll use an analogy, right? Um, let's say you're going to fly in a plane, right? You're going to fly internationally. So you decide, okay, which airline am I going to pick? Well, if there's an airline that you heard about that's got a lot of crashes, you're probably not going to pick that airline. So using the same analogy, when you look at DSTs, the one thing you want to look at is the track record for the sponsor. You can have the best property in the best location, and it doesn't matter if the management doesn't know what they're doing, or if they're not experienced, or they're making silly mistakes, right? So that's the first thing I recommend people to look at. The second thing that I would recommend that they look at is, and this is oftentimes overlooked, but I think a lot of advisors out there are saying just go into this, go into this, go into this. But you really have to understand your client and understand what it is that they really want. I mean, there's some clients that they just don't feel comfortable with multifamily, or they just don't feel comfortable with self-storage. So, understanding what you feel comfortable with, because that is important, right? You should be investing in things that you feel comfortable with as an asset class. The next thing to look at is the fee structure, the costs involved, when you're investing in a DST. That's where we come into, we look at that before, and when we're advising our clients, but you want to look at what is the cost to get into this? And what is the probability that we're going to recoup our principal back in 5 or 7 years? Because really, when we're advising, the first thing that we're focused on is principal preservation, right? That's number one, because the client should be getting, their regular monthly distributions,
Mm-hmm.
and that's great. That's obviously a form of return. But in 5 or 6 or 7 years, if you bought like a Dollar General in a tertiary market, right? And there's 10,000 people living in that town, and that Dollar General leaves, that's a big problem, right?
Yeah.
So it's looking at the asset, it's looking at the sponsor, it's everything. That's the other thing. DSTs, like, they're mystical to some people, but it's really looking at the same thing that you would look at if
Yeah.
you were looking at any other deal. One difference is that here you actually get the benefit of seeing a track record for the company that's going to be managing your asset.
Yeah, no, that's great. You bring up a great point about the Dollar General. I feel like I use that analogy quite often about, just, looks like a great investment, credit tenant, obviously, but like, what is that building? If they don't, if there's not multiple options after maybe the initial 10-year term, what the hell do you do with that building in the middle of podunk nowhere, right? It's probably not worth much. It's just a metal shell at that point in time. So no, all good.
Exactly.
Yeah. So I'd like to dive a little deeper into the fee structure, and I'm assuming there's probably fees on both sides, both with your group being a service advisor, advising clients, but then also even on the sponsor side of things. So just help me better understand, and more importantly, as it relates to how do people identify if they're going to go out there looking for groups like yours, like who's taking advantage of, maybe because the fee load is significantly higher than norm, and who's obviously doing the right thing.
The good thing about this industry in general is that I should have said this in the beginning.
Regulated.
DSTs fall in under securities, right? So we're not, even though I'm a licensed real estate broker, it's not under that license. We're not realtors, we're not real estate agents or brokers. We actually have securities licenses. So, our governing body in our industry is FINRA. So when you invest in a DST, every DST comes with what they call a private placement memorandum, or PPM, and that's required by securities laws. And then that PPM, which is typically pretty long, like 250, 300 pages long sometimes, it's a great way to fall asleep at night if you're having insomnia. You just go read through the PPM. But they tend to be pretty standard. And within that PPM, you're going to have a breakdown of all the fees and costs that are associated with this investment. And it's typically, there's a page on there in the PPM called estimated use of proceeds. And I encourage people, if they're looking at a DST, and if you're concerned about fees and costs, go to the estimated use of proceeds, because it's going to delineate and outline exactly who's getting paid what, in the process. And look, the first thing I'll say about fees and costs is, when a client invests in a DST, let's say they invest $100,000. some of that $100,000, yes, that's obviously going to pay for these fees and costs. But when they look at their statement, when they're getting paid, let's say it's a 5% return, they're going to get 5% on the full equity that they invested.
Hmm.
So it doesn't reduce the return on their equity invested, but they are spending the money. The money has to come from somewhere. So typically the fees and the costs are broken down into a few categories. Do you have uh, um, the commissions that we would get paid, right, as representatives of the client, but then we're getting paid by the sponsor. And depending on the sponsor, it's typically anywhere between 5 and 6%, right, of the equity invested. You then have acquisition fees that the sponsor had to undertake, legal fees, accounting fees, marketing fees.
Hmm.
Um, and look, there are some sponsors that we don't work with because we think their fees are outrageous. But having
Yeah.
said that, when you're looking at the quality of the real estate and you're looking at, um, if you were to go out and buy some things by yourself, the delta is not that too much. It's not too much different if you were to go out a lot of times and buy something yourself, and with the added benefit of going into institutional quality real estate
Yep.
and diversification. So the fees are definitely something to keep in mind, and people need to be aware of it. But I think that they also need to keep in mind that what's most important is, I'll give you an example. If you came to me and said, Ehud, I'm going to pay you 50% annualized return. I'm just exaggerating, obviously. And let's say I'm going to pay you a 50% annualized return if you invest your money with me, and here's my track record, and I've been doing this for 50 years. And I say, great, Kevin, I would even ask you what you're making. If you're making 1,000% return, I don't care because all I care about is that I'm making my 50%. As long as you protect my principal, as long as you are a good custodian of my funds
Yeah.
and the return makes sense to me, that's all I care about. So I think fees and costs are important, obviously, but the most important thing to look at first is what are you buying? What are you investing in?
Hmm. Yeah, no, I appreciate that. And so, just the initial conversation, if someone's tuning in here, they have an interest in chatting with you. I mean, what are I know we went over it already, but just maybe let's consolidate this to, the three most important things that they should, be asking you or bullet points for that first conversation as they look to go down this path.
Well, I think that one of the first things they need to understand is if they're talking to anyone in what we do in our world, they should ask, okay, what is your experience? Like, what kind of due
Mhm.
diligence are you doing behind the scenes? How do you know that this is a good investment for me? And I think that's a fair question. If you went to a dentist and that dentist didn't have a degree on their wall or something like that, and they picked up dentistry on the street, probably don't want to go to that dentist. They're not a dentist. So I think understanding who you're speaking with, their background and the kind of behind the scenes work, so to speak, that's number one. Number two is I think you really want, if you're looking at an investment, let's say it's multifamily or self-storage or whatever it may be, I really encourage people to also not just talk to the advisor that they're talking to, the person that's helping them choose which DST to invest in. I would recommend they speak to the sponsor as well,
Mhm.
because the sponsor is more than happy. They've got their own representatives that they can speak to and ask them questions, set up a call with them so you can ask them directly because these are the people that are going to actually be managing your money.
Yep.
Our job is to help you pick, but after that, we'll keep helping you if you need anything. But really, it's the asset manager, it's the DST sponsor that you need to feel comfortable with. And then, finding out their track record, how well they've done, how well they haven't done. That's what I encourage people to do. And then if you have any questions, you're reading through the PPM, ask your advisor. And if that person cannot answer your question, maybe you should consider finding someone who can. So
Yeah. No, that's great advice. And one other question I personally have, don't know the answer to it, is are the sponsors typically are they also participating in the deal as far as putting equity into the deal, or how does that work?
that's a great question. Some of them do. Some of them hold a position in these investments. Uh, but for the vast majority of the time, they buy the asset, they acquire the asset, they raise all the equity to get them out of it, and then they go on to the next deal.
Got it.
Occasionally, you'll have a sponsor that is co-invested with the
Got it.
investors, but that's rare.
Okay, good deal. Here,
Yeah.
this has been a great conversation, man. I appreciate you coming on. Lots of valuable insights. For those that want to learn more, where's the best place to reach you?
So we're at perchwealth.com. You can see the
Okay.
wait, other side, perchwealth.com. You can call me direct. My number is 858-201-7659. Happy to help. We have an amazing team. My email is egerston@perchwealth.com. You can go on our website. We have a YouTube channel. We have a lot of educational videos on our YouTube channel. Just type in Perch Wealth on YouTube. Uh, yeah, we're on LinkedIn. We haven't done
Awesome.
any Instagram yet, but maybe one day. Maybe a younger demographic, but who knows?
Yeah. There's only so much time in a day, my friend.
I know,
No.
believe me. I
Yeah. Yeah.
know.
Well, I appreciate you coming on the show. It's been a pleasure having you, and wishing you all the best, and maybe we'll catch up another time. And I know there's a lot of other topics we could talk about today, but we focused on DST. So again, appreciate you coming on. Wishing you all the best, and guys, we'll put all that information that you just shared there in the show notes as well. Links to the website, links to the social pages, and my friend, loved having you. It's been a fun
Thank you,
conversation.
Kevin. A pleasure. Thank you again.
Alrighty, guys, that's all we have for
All
this
right.
week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.